Mud flies, water surges over the hood. 4 electric motors deliver instant torque as the truck launches forward without a single combustion sound. The speed feels violent. The silence feels unnatural. The dashboard glows with digital precision while the chassis absorbs rock and sand as if physics itself signed a partnership deal. This is the Rivian R One T in motion, a machine engineered to dominate terrain, conquer gradients, and redefine what a pickup can be. But behind the spectacle of torque and traction lies a far less cinematic story. Strip away the slow-motion shots and wilderness backdrops, and the central question becomes unavoidable. Can the company building this machine survive long enough to justify the promise? The Rivian R One T is the flagship product of Rivian Automotive, a company that entered public markets with historic valuation levels and expectations that bordered on industrial transformation. Investors did not price this as a niche startup. They priced it as a future pillar of the electric era. That assumption now collides with economic gravity. Rivian's financial model has been defined by aggressive capital expenditure and persistent operating losses. The Normal, Illinois manufacturing facility represents a massive fixed cost structure. Robotics, battery module assembly, quality assurance systems, and continuous retooling require sustained cash outflow. When production volume does not scale at the pace initially forecast, fixed cost absorption weakens. Each unit carries heavier overhead allocation and margins compress further. Cash burn remains the core vulnerability. Even after multiple capital raises, Rivian continues to operate with negative free cash flow. The company must fund research and development, service network expansion, charging infrastructure commitments, and supplier prepayments simultaneously. These are not optional expenses, they are structural requirements of competing in the modern automotive industry. Debt exposure has increased as the macro environment shifted. Early funding cycles benefited from abundant liquidity and speculative enthusiasm around electric vehicle growth. That environment has normalized. Interest rates are materially higher, and capital providers now demand clearer paths to profitability. Convertible notes and other structured debt instruments introduce refinancing pressure. If equity valuations remain volatile, conversion becomes less attractive, and issuers may be forced to repay principal in cash. Unit sales growth has not matched early projections that justified initial valuation levels. The premium electric pickup segment is no longer uncontested. Legacy manufacturers with established dealer networks and strong brand loyalty have entered the field. These competitors possess diversified revenue streams that allow cross-subsidization of losses in electric segments. Rivian does not. Every negative quarter directly reduces liquidity reserves. The R One T occupies a high price bracket. In periods of elevated auto loan rates and tightening consumer credit, discretionary high-value purchases slow. Order backlogs can shrink quickly when affordability becomes strained. Cancellation rates rise when buyers reassess monthly payment commitments. A premium electric truck is highly sensitive to macroeconomic fluctuations. Residual value risk introduces a secondary stress factor. Electric vehicle depreciation patterns remain volatile due to rapid technological advancement and battery longevity uncertainty. If secondary market prices decline faster than expected, leasing partners absorb losses and adjust future terms. Higher lease rates reduce accessibility. Lower trade-in values discourage repeat purchases. This creates downward demand. Pressure. Supply chain dependency amplifies exposure. Battery cells, semiconductors, and specialized components must be sourced at competitive cost. Rivian does not yet command the scale leverage of global incumbents. Supplier concentration risk remains elevated. Any disruption forces production delays or cost increases, both of which strain margins further. Infrastructure obligations also weigh heavily. Building and maintaining charging partnerships and proprietary service centers requires capital that does not immediately generate profit. Expansion of service capacity is essential to maintain customer satisfaction. However, every new facility increases operating expense before revenue scale justifies it. Please subscribe to our channel. We want to hit 1,000 subscribers this week. Strategic capital allocation decisions now face heightened scrutiny. Expansion plans for additional manufacturing facilities signal ambition, but they also demand billions in funding. Delays or restructuring of these projects can signal liquidity preservation mode. When a growth company pivots toward defensive cost control, it reflects recalibration of survival probability. Operational execution risk remains visible. Early production phases in new automotive companies often involve quality inconsistencies. Warranty claims and service campaigns consume cash. If service wait times lengthen due to parts shortages or technician capacity limits, consumer confidence erodes. In automotive markets, reputation damage spreads faster than corrective action. Workforce adjustments are another indicator. Layoffs or hiring freezes may preserve short-term liquidity, but signal internal acknowledgement that growth assumptions have weakened. Cutting research and development spending may slow innovation in battery efficiency, software capability, and performance optimization. In a competitive electric segment, technological stagnation reduces differentiation. Investor sentiment has shifted from growth at any cost to margin discipline. Public markets now reward companies that demonstrate credible timelines toward positive operating income. If Rivian continues to report negative gross margins on vehicle production, skepticism intensifies. Equity dilution becomes more punitive as share prices decline. Raising additional capital at depressed valuations transfers risk from creditors to shareholders, but does not eliminate underlying cash burn. Bankruptcy risk must be discussed in probabilistic terms. Persistent negative cash flow, upcoming debt maturities, declining unit demand, and inability to secure favorable refinancing collectively elevate restructuring probability. While immediate insolvency may not be imminent, the risk horizon narrows if macro conditions deteriorate or capital markets tighten further. Forced acquisition represents an alternative path. A larger automotive group or strategic investor could absorb Rivian's assets, technology platform, and manufacturing footprint. Such outcomes often preserve product lines but alter brand autonomy. For consumers, acquisition can stabilize service support, but it can also lead to integration disruptions. Consumer red alert. For buyers considering the R One T, corporate durability matters as much as torque output. Vehicle ownership extends over years and is often financed over long terms. Manufacturer instability directly affects warranty fulfillment, software updates, and resale value. If liquidity pressures intensify, cost containment could slow expansion of service infrastructure. Parts procurement could become constrained if suppliers tighten credit terms. Repair timelines may extend. In extreme restructuring scenarios, warranty obligations could be renegotiated under legal supervision, introducing uncertainty for owners. The R One T depends heavily on software architecture and over-the-air updates. Continued improvement of range optimization, user interface refinement, and performance tuning requires sustained engineering investment. If financial strain forces reductions in software teams, update cadence could slow. A technologically advanced truck without ongoing support quickly loses competitive relevance. Resale value volatility should be carefully considered. Vehicles produced by financially unstable manufacturers often depreciate faster. Leasing companies incorporate survival risk into residual calculations. Lower expected resale value increases monthly lease cost. For owners planning to trade in within several years, this risk translates directly into financial loss. Financing institutions also evaluate manufacturer stability. If corporate risk rises, lenders may tighten underwriting standards or increase interest rates for that brand. Insurance carriers may adjust replacement cost assumptions if parts availability becomes uncertain. The direct sales and service model centralizes operational exposure. Unlike traditional dealer networks that operate with some independence, Rivian's structure means corporate-level disruptions can ripple quickly across the entire ownership ecosystem. There is limited decentralization buffer. Prospective buyers should monitor quarterly cash balances relative to reported cash burn. They should review disclosures regarding debt maturity schedules and refinancing plans. Announcements of program cancellations, executive departures, or delayed facility construction provide signals about internal stress. The R One T delivers impressive performance metrics and distinctive design language. Yet emotional appeal does not offset balance sheet arithmetic. Purchasing a vehicle from a company with sustained negative margins effectively assumes that capital access will remain available for the duration of ownership. Approaching 2026, Rivian faces intersecting pressures of debt servicing, infrastructure expansion, competitive intensity, and consumer affordability constraints. Without a demonstrated transition to consistent positive gross margin and reduced cash burn, Risk classification remains elevated. Innovation alone does not guarantee survival in the automotive sector. History shows that companies with compelling products can still fail if capital structure becomes unsustainable. For investors, creditors, and consumers, the central variable is not acceleration speed, but financial endurance. The Rivian R One T charges through mud and water with confidence. The company behind it must now navigate a far harsher terrain defined by capital markets, refinancing cycles, and margin accountability. Until financial stability is proven through sustained results rather than projections, caution is not pessimism, it is discipline. Please subscribe to our channel. We want to hit 1,000 subscribers this week.